Bismillah ar-Rahman ar-Rahim. We will continue. So let's see some examples of how the balance sheet changes. Suppose a new machine is put into service. Suppose that the company has just purchased a new machine that will be placed in service to replace one that has failed. The first activity that occurs is that the company receives the machines from the manufacturer. When the machine is delivered and the company receives the bill, two things will happen. First, the plant in service account is increased by $10 million and the accounts payable entry is increased by $10 million. Assuming that we have not paid yet and this is delivered on credit, accounts payable is then increased by $10 million. So the balance sheet, remember that it's a double entry bookkeeping. When this has happened, how the balance sheet is going to change? We are going to increase the accounts payable by 10 million and at the same time we are going to increase the equipment. So that is how the change is occurring. 10 million here, 10 million here. The company may wait 30 days and then pay the bill, $10 million bill. Then the account payable is decreased by $10 million and the company cash account is decreased by $10 million. Look at that. We have the situation that we had to pay, account payable was 10 million and 10 million in the equipment. Now what we will do is the company will pay the cash, pay by cash the accounts payable. So we have minus 10 million here and minus 10 million here on the cash side. Double entry again. As an option, the company may elect to borrow 10 million to pay for this machine. It would issue bonds of $10 million as long-term debt. Now the long-term debt is increased by 10 million and the cash account is increased by $10 million. So it is possible that the company may borrow money and through long-term debt. So instead of because they have paid the cash is not there now, they want to increase the cash and the $10 million can be raised by long-term debt. So we have increased the debt here on the right hand side, the liability has increased, and on the left side also the cash has been infused as well. Now we come to income statement. We will continue with some more examples and exercises, of course. But first of all, let's look at the second statement, important statement, that is income statement. Another financial statement is the important one is the income statement. The income statement or the profit and loss account statement is also called profit and loss account statement or profit and loss statement. Each report is a cumulative record of the revenues and expenses incurred by the firm during a stated period of time. Normally 1 year we can say that. The governing equation, if you remember, was that the income or profit is equal to revenue or sales minus expenses. So let's look at that. First of all, the first item is the revenues or sales, then minus the expenditures, maybe operating expenditure, maintenance, depreciation, property taxes. This becomes an operating income. The company may have other incomes as well, other non-operating income, and then this income may be coming from real estate business they have or some other somewhere else. So this is their non-operating income. earnings from before interest and tax. It is called EBIT, earnings before interest and tax. And then you pay the interest, and after paying the interest you have the taxable income. Then you pay the tax on that and you have the net income. On the net income you pay the dividends to the preferred stockholders if they exist. Otherwise that net income is then divided into dividends and the retained earnings. That is the simple income statement, or we can say consolidated income statement. Let's go through these items one by one. Revenues or sales. At the top of the income statement are revenues or sales of products or services. Then we have the expenses. The largest expense for a company is its operation expense. It may be the cost of goods sold also. The other operation cost may include staff salaries, selling and administrative expenses, etc. Maintenance expense may be another major expense item for some companies. Then of course they have to pay taxes, property taxes also. Depreciation. Next item is depreciation. Depreciation expense accounts for the annual charges associated with economic wear out of company plant equipment. Remember that when we were talking about depreciation in our cost accounting lecture, we said depreciation is a charge against revenue. That is the concept in accounting. It's a charge against the revenue. It's an expenditure. It's an expenditure and it is charged against the revenue. So depreciation over here is shown as an expenditure. The life of the plant may be 5 to 40 years depending on the type of plant and equipment. Annual depreciation expense are normally calculated by straight line depreciation method, or for tax reporting separate method can be used. So we have also learned the different depreciation methods in the cost accounting lecture. In financial accounting depreciation, we can use the straight line depreciation, but for tax purposes we may use some other method in which we can show that the asset has been quickly depreciated to show more expenditure, and thus showing less income and eventually paying less tax. The next item is the property taxes, the proportion to the value of the property that is in service. Then we have the operating income. Operating income, if expenses are subtracted from revenues, these are our expenditures. If we subtract them from the revenues, then we get the operating income. Operating income is providing for interest charges, dividend requirement the company has to provide to its debt holders and equity participants. The company may have other non-operating income. Total income that the company receives may include other components. Non-operating income may be, for example, the rent that the company would charge to another company for using its properties, and other miscellaneous sources of income that are not directly associated with the production of goods or services that the company is producing or providing. So if it is not its main business, if they are getting something on from other investments, then that is the other non-operating income. For example, electricity company has the poles and the wires are there. These poles and wires can be used for these telephone lines also. Telephone lines can run parallel there. These poles can be used, or the signals can be sent, the telephone signals can be sent from on the power transmission lines as well. So this is they can charge the rent for using those transmission lines, or anything the company may have in other, not in the main business, other income coming, that is the other non-operating income. Then we have the earnings before interest and tax, EBIT. The total of operating income and the non-operating income yields earnings before interest and tax. So the operating income plus this income, other non-operating income, we get the earnings before interest and tax, EBIT. From EBIT, the interest charges are deducted, so less interest. Interest charges include both long-term interest that is paid on bonds and other financing vehicles, including short-term interest charges. EBIT minus interest is the taxable income. So this is our earnings before taxes, the taxable income. Taxable income. It's not writing. Okay, anyway. EBIT minus interest is the taxable income or earnings before tax on which the income tax is paid to get the net income. Then we have the net income here. The objective of any business enterprise is to generate the earnings necessary to provide adequate return on investments of its equity participants. If net income falls short, the business enterprise will not have reasonable access to the financial markets and will not be able to expand its system to meet consumer demands. The net income provides for the preferred stock dividends for the preferred stockholders, as well as common stock dividends for the common stock owners. After preferred and common stock dividends are subtracted from earnings, the remainder is called retained earnings. Retained earnings are reinvested into the business. So we have net income, and this net income is for now for the equity holders, which are the preferred stocks and the common stocks. So first of all, the preferred stock dividends are given, and then the common stocks dividends are given, and eventually whatever is left is the retained earnings. And remember that this retained earning goes into the balance sheet. So this is annual retained earnings, which is the income that the company can use to, or the profit that company can use to expand its operations. Available for common stockholders, which is after giving the preferred stock dividends, which is the income which is there is for common stockholders. Available for common stockholder is an item that is also usually itemized on an income statement. This item reflects the net income of the company less the preferred stock dividends. Available for common stockholders is exactly that, the total amount of money available for use by the common stockholders. This money may be completely paid out in dividends to the common stockholders, or it may be completely retained by the company and reinvested. Typically 60 to 70% of the funds that are available for common stockholders are paid out in common stock dividends. This varies, of course, from company to company and depends on the company's financial health. On the average, the company reinvests 30 to 40% of the funds available to common stockholders. These are reinvested, called retained earnings. Retained earnings on the income statement are added to the beginning of year accumulated retained earnings on the balance sheet to compute the retained earnings at year end. Remember that the link between the balance sheet and income statement is the retained earnings. Let's see an example. The income statement example. The company, suppose on February 26, company purchases raw material of $10 million. The balance sheet change, let's say on February 28, and on March 26 the company pays the raw material bill. So the first thing is the company material and supplies have been increased by $10 million, and the account payable is also increased by $10 million. The company has bought something on credit, so account payable has increased 10 million, and of course they have got the materials and supplies for $10 million. Let's assume an example of a company that is an electricity company. It's easy to visualize that. Let's say the electricity company is there, which got fuel from some fuel company, let's say natural gas, on credit, and their account payable is of $10 million, and their material and supplies is $10 million, the fuel they have bought. Now the balance sheet changes on March 31 by paying the cash. Let's say the paying by cash, so the cash has been reduced by $10 million, and at the same time the accounts payable has been decreased by $10 million. Let's say that material and supply which came has been used in generating the revenues. The fuel has been used to produce electricity, and that is shown over here in the income statement. It uses the raw material to make finished product or service. Income statement, how it changes, we have the expenditure. What are the expenditures? The fuel has been used, $10 million of fuel has been used, and the income of course is minus $10 million, and the annual retained earning is minus $10 million. The balance sheet changed now on April 30. We have the situation here earlier, and now we have the retained earnings minus $10 million coming from income statement, and of course the material and supplies have been used also, minus $10 million. Now this is suppose May 1 to 31, May 31, the company sold the finished product or service. We assume that the company got the revenues, they sent the bills of electricity, and they received the electricity bills, and they got the revenues, and let's say they received $20 million from there, and this minus $10 million were earlier the fuel used to produce that. We got now $20 million. Net income has become 10 million now. 20 minus 10 is 10, and the retained earning has been increased by $10 million. Now balance sheet change May 31 now. We have now the retained earnings now $10 million. So 20 minus 10, which is 10 million. So $20 million has been added, and of course we have also the cash has become $10 million. We have seen the income statement, which was more of a service company. Let's look at company which is making some manufacturing some product or so, how this income statement looks for that. The items which are on the income statement are sales or revenues. Let's say these are given in millions of dollars here. So the sales and revenues are there, the first item. Then the second item is the cost of goods sold. Cost of goods sold, remember that when we talked about ABC costing, the cost of goods sold are the three things in it. Three major items of costs are there. What are those? Direct labor cost, direct material cost, and overhead costs. And this is the major expenditures. So cost of goods sold are here, and in the parentheses shown here, which means that these are minus. Okay, these are expenditures. Gross margin is then the difference between the sales revenue minus the cost of goods sold is called the gross margin. All right. Then we have other expenditures like general, selling, and administrative expenses are there, again shown in parentheses, denoting the fact that these are negatives. Pensions, benefits, R&D, insurance, etc. is there. State, local, and miscellaneous taxes are there, and then depreciation is there. All are negative. And then we have the earnings before interest and tax, EBIT, which is gross margin minus these expenditures. Then we have the interest and other related cost related to debts, and that is remember that the tax is paid after deducting the interest. So first the interest is paid. This is our interest is paid here. Okay. And then we have the taxable income, and then on that we pay the tax. Corporate tax is here, and then we get the net income, and then the common stock dividends are there, and retained earnings are there. Net income, maybe if there are no preferred stockholders, then this is all for the common stock holders, all for them. So this income can be divided into dividends and then for retained earnings. Here remember that more retained earnings are shown and less of dividends are given. So it depends on the company policy. They may give more dividends and less for retained earnings, or vice versa. Factors in choosing the depreciation method. Okay. Depreciation affects both income reported in the financial statements and taxable income on tax returns. Depreciation affects both income reported in the financial statements and taxable income on tax returns. A firm does not need to choose the same depreciation method for the both financial and tax reporting purposes. That's why we discussed that. Remember, we discussed this depreciation in cost accounting lecture, and we discussed that the company may change from straight line depreciation to some accelerated depreciation method, like we discussed, I think, double declining balance method, or sum of the year digits method. These are, or accelerated cost recovery system method. Any of these fast recovery of this showing more depreciation is method can be used for tax purposes. So tax reporting, in selecting depreciation method for tax reporting, the firm should try to maximize the present value of the reduction in tax payments from claiming depreciation. Earlier deductions are worth more than later ones because a dollar saved today is worth than a dollar saved tomorrow. Remember that we are showing more expenditure by accelerated depreciation, and then showing less of income, earning before interest and tax. Then of course you pay less taxes, and then when you pay less taxes by showing less income or less earnings, then you have more cash, because depreciation is not a outflow, cash outflow. It is in your pocket. so that money can be used for some other purposes, the time value of money, and that's why the companies go for different depreciation methods. For financial accounting purposes, they can show straight line depreciation, and for tax purposes, they can show some accelerated depreciation. Of course, this discrepancy has to be reflected in the balance sheet, and in the balance sheet they reflect it by showing it as deferred credits. When we were discussing the deferred credits, that's basically we are noting down the extra liability of the taxes which we have to pay in later years. A firm will generally choose the alternative that meets the general goal of the following: to pay the tax as late as possible within the law. For financial reporting, for long-lived assets seeks an income statement that realistically measures the expiration of assets, benefits, and provides a reasonable pattern of cost allocation. The overwhelming majority of firms use the straight line method for financial reporting. The next very important statement is called the cash report, cash flow statement. It's also called sources of fund and uses of or application of funds statement as well. The third key financial statement is the cash report statement, also called sources and uses of fund statement. The cash report begins with the cash account balance at the beginning of the year. All the sources of cash are presented, as well as all the applications of cash. The difference between sources of cash and applications of cash is the computed net change in cash. The beginning cash balance added to the change in cash equals the cash at the end of the year. Income statement for cash report example. Let's say we have this income statement. We are going to use it for cash report, making the cash report. Suppose we have the income statement showing the net income. The next slide will show the cash report. Here the data is a zero cash balance at the beginning of the year, and the company has to pay dividend to its stockholders. Assume $100. Let's say the company had a revenue of $1,000. It could be 1,000 millions, which is $1 billion, etc., or let's say $1,000, whatever. And then we have the operating expenditures shown in parentheses, 600. Some depreciation is shown, $100. The operating income is then the revenue minus these expenditures. And then we have EBIT. Let's say other income is 0. Then the operating income is the same as the EBIT, which is the earning before interest and tax, 300. And then you pay interest. After paying the interest, let's say it is 0. Then after paying the interest, you have the taxable income. This is your taxable income, earnings before tax, which is the same as 300. I think I should have put over here $300. Okay, then you pay tax. Let's say $100 is the tax. Then the net income is $200. This $200 can be then given either completely as a dividends. 100% can be given to the shareholders as dividends, or some of them can be kept. Here we have shown that $100 is given as dividends, and 100 has become the retained earnings. Okay, we will use this example to see how the cash report we can construct from the income statement. So look at that cash report example. Cash at the beginning of the year is, let's say, 0. The cash from operation sources internal net income was $200. Right? Remember that net income is summation of dividends, common stock dividends, plus the plus the retained earnings. So net income is 200. Okay, then we have the depreciation 100. Remember, depreciation is an expenditure, but it's not a cash flow. It is not a cash outflow, so we add that $100 also. Then the total sources of cash become 300. Okay, and then the application of cash, we have given them dividends $100, so the total fund dispensed are 100, and the cash at the end of the year is 200. Okay, another statements which are there are called retained earning statements. The retained earning statement also plays an important role. This statement shows how the accumulated retained earnings change from the beginning of the year to the end of the year. For example, if the retained earnings in the beginning of the years are, let's say, 800, then the retained earnings at the end of the year are increased by the net income or profits generated by the firm, which is $200 less the amount the firm pays on dividends is 200. So 100 increases there. Thus the accumulated retained earning below at the end of the year is 900. As shown over here, we have balance beginning of the year is 800. We have net income 200, but we have given $100 a dividend. Then we are left with 900 at the end of the year retained earning balance. Let's look at the balance sheet change. We have, let's say, the beginning of the year, we have, this is the situation, we have utility plant in service was 1000, and then we have some accumulated depreciation was also 1000, and some construction work is going on in progress, it is 1000 as well. The current assets, the cash receivables, let's say 0, the total assets are now 1000. Because here 1000 minus 1000 is 0, then again 1000, we have total asset is 1000. Long-term debt, let's say is 100, and we have the common stocks is also 100, and the retained earnings, let's say coming from the previous year is 800. And then current liability is 0, deferred credit 0, and we have the total liabilities is 1000. Remember that balance sheet means balance, so it means that the total assets should be balanced with the total liabilities, which is of course the plus equity as well. This total liabilities are plus common plus equity, owner's equity. Owner equity. Okay, doesn't show well. Okay, then let's say it was the situation of the beginning of the year, which means it was the end of the previous year, and now after 1 year the depreciation has increased by 100, so we have delta is equal to minus 100. The construction has been completed, so now we have the utility plant has become increased from 1000 plus 1000, this has become 2000, and the construction work in progress is made to 0. The cash has been increased by $200. Remember the cash report statement, go back if you like to see the cash report, and we have a $200 infused there, so this is the $200 here, and the total assets now has become 1100. On the liability sides, we have the same, long-term debt is same, the common stocks are same, retained earning has increased by $100, so it has become 900, and again the total liabilities plus owner equity, we have alarm 100. So it is same as balanced. Now we will see some exercise on balance sheet, and we will also try to construct balance sheets and income statement.